Okay, folks. Quick reminder, your third quiz is a week from Wednesday. So it's next week, the 26th. And once you hit the 26th, we're on, we have 3 more sessions of classes, and then the project is due May 8th and the final is May 11th. So everything's going to come at you, which effectively is my way of saying, if you want to get caught up on things, this is the week to do it. So if you have lots of other stuff planned, move them out of the way and get this done. Because and the pricing, as I said, should not take that long if you're willing to invest a few hours in it. Now, somebody asked me, where's the group part of this group project? There's very little group work involved in this group project. It's mostly on your own. The only thing groupy about it, if you can call it a group project, is eventually you'll have to bring your group projects together. And the only reason I keep it as a group is so I'm not the only one nagging everybody in a group, because if you have people who are lagging in your group, you might want to nag them as well, because they'll eventually get it done. It always gets done. But there would be people who infuriate you by working only on that last weekend and you have everything ready to go. And not much you can do. You can do only what you can do. You can control your own project. Okay. So let's continue with the discussion. Today, we're going to finish up pricing. There's not much left to do. I'm going to show you the market regressions across regions. But we're going to start, we're going to start and complete what I call asset-based valuation. We value a company based on its pieces. So let me start with a very simple question. Right? You take a company like Coca-Cola. You value it as a company, right? But Coca-Cola is in 72 different countries, every continent. Could you value Coca-Cola by geography? North American operations, Asian operations, European. What's the advantage of doing that? Of breaking down Coca-Cola geographically and valuing individual geographies. That
get a sense of where the value at a corporate level is really being derived from.
And also it allows you to. And also you can vary growth rates. So Asia is growing and the US is mature. You can use different growth rates, different costs of capital. In fact, anytime you have a multi-business company, you can, the nice thing about present value is it's additive. You know what I mean by that? You value the whole, or you can value it in pieces. And in theory, at least, you could argue that valuing a company in pieces should give you a more precise valuation than valuing it as a composite. Because you take these big companies, you value them as a composite whole, you're making assumptions. So let's say the way we compute equity risk premium, you take a weighted average, right? You know what the problem with that, though, is? That I never mentioned, your weights can change over time. If you're growing fast in Asia and you're mature in the US over time, and who has the time to work out what the weights will be 1 year from now? Whereas if you do a geographical based valuation, you don't have to worry about weights. Each part has its own growth rate. So in theory, you can ask, why don't we do this with every company? Break it down into pieces and value each piece. As a catch, though, right? to value Coca-Cola geographically, I need information geographically, like what? Every single item, operating income, capex, depreciation, working capital, everything we need to value an individual company, now I have to do individually. Think of how much you struggle to do one story in one company. Think of doing this for 5 geographies, and you're going to very quickly recognize that this requires a lot more information. It's a trade-off. Most of the time, the trade-off is going to lead you to value the composite company, because most companies don't break down information on a piece-by-piece basis in enough detail for you to be able to do the piece-by-piece valuation. Let's follow up on that. One of the things we're going to talk about today is what's called sum of the parts valuation. In fact, there's an acronym that people use, SOTP. The first few times I said, what the heck is that? The sum of the pieces. And you could argue that there are people who might care about some of the pieces, either because they want to take over a company and break it up into pieces, or because they want to make an investment judgment eventually. So let's assume that you can value a company as a composite and you can value the company as a sum of the parts. Which of the following is going to be the result you arrive at? First is the sum of the parts has to be equal to the value of the company. Is it possible the sum of the parts is greater than the value of the company? In which case, what has to be true? Or can the sum of the parts be less than the value you get for the company? Yes, sir. It can. If I replace value with price, it can be all three. If I truly value a company, I should really get the same value, because value is value, whatever concerns me. But with price, you're absolutely right. The price can be equal, the price can be great. If the price is greater than the sum of the parts, you might say there are differences because the corporate status adds some value. If the price is less, though, it creates a bit of an arbitrage opportunity, right? Because to the extent that you're right, you can buy the company, break it up, sell out, the pieces go for whatever they're worth. It should be greater than the price you paid for the company. So this is actually an argument for people buying up. Sony's been targeted now for like a decade. People have talked about how it's worth more as the sum of its parts. Last year, before Bob Iger came back to Disney, there were people talking about how Disney was worth more than as the sum of its parts as it was over the individual company. So you'll see equity research analysts do what they call sum of the parts valuation. I'm going to argue that most of the time they don't do any sum of the parts valuation. They do sum of the parts pricing. You know what that means? They take each piece of the company, they'll price it. By doing what? Applying a multiple. It's actually back of the envelope. It's the kind of thing you would do after a dinner. You've had 3 drinks and somebody says, what do you think Disney's worth? Pull up the envelope, you pull up the EBITDA for each part, you multiply by the multiple for each part. It's not the kind of thing you do at most dinners, but if the dinner with the right person, maybe Carl I can, and he says, what do you think? But it's not particularly detailed. So today we're going to talk about actually doing a sum of the parts valuation and what it involves. And I'm going to use a company called United Technologies. Company that used to be called the poor man's GE, but now I think it's the rich man's GE, given how badly GE has fallen. It's a conglomerate. It's a multi-business company, and in multiple businesses. We're going to do an actual sum of the parts valuation, and as we go through it, you're going to see why most people don't even try this, even if the information there's a lot of messy assumptions and a lot of work, a lot of calculations to go through. So let's turn to, I think, page 94, which is where I left you. So I talked about using that regression coefficient on growth to get a measure of the price of growth. So let me review again. You run the regression of price earnings ratios against payout, beta, and growth. The coefficient you get on growth is a rough measure of how much the market is willing to pay for growth. And the best possible combination, as I said, for a company is to have a low equity risk premium and a high price for growth, because then if you're a risky high growth company, you get this huge price earnings ratio. The worst case scenario is to have a high equity risk premium and a low price for growth. And started 2023, we were closer to the second scenario than the first one. Risk premiums had risen, the price of growth had dropped. things have started to modulate back again during the course of this year. But those two numbers are numbers to watch as a growth company. So as I said, I'm going to just complete the discussion of pricing, not a whole lot more to do by talking about, the other regressions I ran. I showed you the PE ratio regression, right? I ran, I started with a scatter plot of price earnings versus growth, and then I ran a regression across the market of PE ratios against growth, beta, and payout ratios. I wanted to try the same thing with PEG ratios. So again, I start with a scatter plot. Okay. I know this might be just seeing things, but when I did the scatter plot, it looked to me, in addition to being like a shotgun blast, I worried about the linearity. And in fact, if you have any kind of statistics package, I use SPSS, there are linearity tests you can run. They're very simple tests. And in fact, I sent you the link to the statistics class. There's one session on regression that I'd encourage you to watch, because it tells you how do you tell when there's what are the statistics you can use to measure whether there's nonlinearity. So when I ran those statistics on this, it told me it was nonlinear. Now,
sir, can you reshare the screen? Thank you.
Thank you for letting me know. Screen see it. You can see it now, right?
Yeah, perfect. Thank you.
So it told me it was nonlinear. Now, I know there are entire statistics books on what to do when the relationship is nonlinear. I'll tell you what seems to work in finance almost all of the time when you have a nonlinear relationship. I took the log of the growth rate, so the growth rate. What's causing the nonlinearity here is your growth rate doesn't have that much of a spread, but your PE ratio is a huge spread. So I took the log of the growth rate instead of the actual growth rate, and I ran a regression against PE ratios, just one small change. And this scatter plot actually passed the linearity test. So one way to check to see if you have data that's nonlinear is run it through, and if it's linear, take one of the variables, take the log, the natural log, the variable, and run the scatter plot. When I ran the regression, then here's the only difference. Instead of having the growth rate, I had the log of the growth rate. The R squared of the regression is 56.6%. The PEG ratio actually did much better than the PE ratio in 2023. So always the case. The three variables are growth, beta, and payout. But I wanted to take a look at the coefficient of the growth variable. Remember, the original reason analysts created the PEG ratio was they wanted to make growth go away. They didn't want to worry about growth. Look at the coefficient on growth. It isn't going away. It's actually become stronger when you use PEG ratios. So those people using PEG ratios have reversed the direction of growth. Instead of growth being a good thing, it's become a bad thing for PEG ratios. Higher growth companies have lower PEG ratios, and it's actually become a stronger variable driving PEG ratios than before. So if you're going to use PEG ratios, at least be open about the fact that you haven't made growth disappear as a variable. You've made it a different kind of relationship that you got to factor in when you think about low versus high PEG ratios. So the next few pages, don't expect to see, I really put in there for your project. Remember, one of the pieces of your project, you're taking a look at your description, is to price your company against the market. I'm going to be a realist. I don't expect you to run a market regression because it's messy. It's a lot of data. It takes time to work through the data. So you can use my regressions from the start of 2023. And I have these regressions for PE ratios, PEG ratios, price to book ratios, EV to EBITDA, EV to sales, EV to invested capital, 6 different multiples. You can pick whichever multiple works for you. I have the regressions by region. I've just US companies, European companies, Japanese companies, emerging market companies, which is actually my biggest, in terms of number of companies, and Australia, New Zealand, and Canada, because I couldn't figure out where else to put those three. And then I have a global regression of all companies in my sample. You think, which one should I use? I'm going to let you make that decision. If you have a US company, you can use either the US regression or the global regression. Which one's right? You're answering two different questions, right? Because in the first one, you're saying, given how other US stocks are priced, is my stock underpriced or overpriced? In the second regression, you're asking, given how global stocks are priced, is my stock underpriced or overpriced? Different questions, you could potentially get different answers. The one thing you will notice about these regressions, is I always start with it's the same three variables. It's not like I'm running regressions from scratch. I'm running them with beta, growth, and payout ratios in every single, but the R squares are all over the place. The Japanese stocks at the start of 2023, I had the highest R square. I was able to explain the largest percentage of differences in PE ratios with fundamentals. It doesn't make it better or worse. It's just, it's just a reflection of the year. So pick the multiple that you find. And as I said, I have price earnings, PEG ratios, price to book. And with every one of them, you'll notice that I've specified the variables, and the variables you should be able to pull from Capital IQ if you're interested, or for your company, you can use your forecasted growth rate from your DCF. So you have the freedom for your company to specify how you come up with the ROE, the growth rate. You're not constrained to go to Capital IQ and use those variables. Just plug them into the regression, get a predicted pricing for your company. So EV to EBITDA, EV to sales, and EV to I have 6 multiples. Basically, for each one of them, you see the regressions with the R squares and the T statistics. Any questions on pricing? So if you think about it, you have lots of choices when it comes to pricing, right? You can use equity multiples, enterprise value multiples. You can use revenue as a scalar, earnings as a scalar. So I'm going to give you a very quick guide to how to pick the multiple that you want to use in your regression. So on value, you have a choice. Do you want to go with enterprise value? Or do you want to go with equity value? If you're doing a financial service company, there is no choice. You have to do equity value. So don't do banks with enterprise value multiples. You will drive yourself crazy. With every other sector, you have a choice. And if you have a sector where leverage varies widely across the sector, so take a look at the debt ratios. If they're very different across companies, you're better off using enterprise values because PE ratios are going to get skewed by how much leverage you have. So whether you use equity value or enterprise value is going to be driven by first, whether you're doing financial service companies, if you're not, by how much differences in leverage you have. For your scalar, you can have revenues, you can have earnings, you can have cash flows, or you can have book value. In making that choice, first, your choice, if make sure you're being consistent. If you chose enterprise value, your scalar has to be an enterprise value. So if you're doing revenues or EBITDA, you have to use enterprise value as your numerator. If you're doing earnings, you have a choice. You can go with either equity or enterprise value, depending on how you measure earnings. Second, you might have no choice but to use revenues if most of the companies in your sector are money losing, because you need your scalar to be positive. And finally, my preference is to work with a number that is not too affected by accounting choices. So if you feel your earnings per share, net income are driven by too many accounting discretionary choices, you want to avoid those numbers, because otherwise what you might see as cheap might just reflect accounting choices. In terms of whether you want to use current numbers, trailing forward, or really forward, it will depend on your company again. If you have a money-losing company with not much substance now, you have no choice but to move things and look at year 5 or year 10. If you have a company which has substance on all of these, which one you use will depend on where the company is. Is it a mature company or a growth company? And also, it's a company with earnings going up and down. You might want to use some kind of an average across time rather than the most recent year's numbers. And finally, in terms of comparable firms, you have to look at when you pick a group like steel or mining, how much do they share in common? The more they share in common, the better off you are. If you want to check to see whether your pricing is different across multiples, remember, this is an empirical question. Look at the PE ratios, look at the market cap. And if larger companies have lower PE ratios or higher PE ratios, just running a regression of PE against market cap will tell you that. So it's not something you have to decide. Let the data tell you what to do. And in terms of how big a sample you need, if you want to run a regression, you need at least 10. Maybe 9 you can get away with. If you don't plan to run a regression, if you have only 4 companies, you're doing ride sharing, and you say, look, I have just Lyft, Grab, and Uber in mind, you can't run a regression. That's okay. But then you can settle for a smaller sample. But the bigger your sample, the more power you can get to do statistical tests. And remember what I suggested. If you have 10 companies, you can have 1 independent variable. 20, you can have 2. 30, you can have 3. So how many variables you can throw in your regression will increase depending on the size of your sample. So let me conclude the pricing section with a couple of statements that I think are pretty obvious, might as well make them. First is, in a pricing, you're not telling me whether your company is cheap or expensive. You're telling me whether it's cheap or expensive relative to the group you're comparing it to. It's not an absolute statement. It's a relative statement. That's why I used to call pricing relative valuation, but I've chosen to go with the pricing word because I think it reflects what you're doing much better. And second, when you do, when you value asset, when you try to price something, you're going to have a really tough time finding something exactly like it. So no matter how hard you try with your comparable firms, there will be differences. You can choose to ignore the differences, and I'm okay with that. But then at least be open about the fact that saying, I'm ignoring the differences, just comparing the average. But if there are differences and you can control for those differences, your pricing becomes more powerful. So pricing is perfectly appropriate way to put a number on an asset, but philosophically, you're approaching putting that number in a very different way than we did DCF. Any questions at all about pricing? Any aspect of pricing? Multiples, comparables use what? No. So I actually think of the world as divided into investors and traders. And I think I've mentioned this: traders price things, investors value things. Traders make money by buying at a low price, selling at a high price. So if you're a trader, you should be using multiples and comparables, even charts, because you're interested in playing the pricing game. Yes.
So let's say I'm, deciding which regression to use. Do I completely ignore R squared? Say I have a R squared for.
You don't completely ignore it. I mean, if you have an 85% versus a 6%, it's a no-brainer, right? But it shouldn't. So if you have, let's say, an EV to EBITDA regression, which is a 52% R squared, and a price to book regression, which is 40%, and intuitively you feel the price to book regression. Now, it gives you the one thing is this is a place where bias is going to show up, right? What makes your life easier, to have a pricing that backs up your DCF or a pricing that is divergent from your DCF? Backs it up. Your report is nice and clean and tidy. I understand that. So if you find the price to book ties much more closely to your DCF conclusion and makes your report easier to write, go for it. But remember what you did, because when people use pricing on you, remember that bias also kicks in the way people pick multiples. But I think it does make sense to pick multiples you can explain more of. But 50% R squared versus a 40% R squared is not different enough to drive that choice. There, if you pick the 40% R squared and say, now, the other way to think about the multiple you want to pick is think of what people in that sector, managers in that sector, tend to focus on, and you get a sense of what multiple makes the most sense. I'll give you an example. If you follow retailers, every retailer, when they report their earnings report, there are two numbers retailers tend to kind of obsess about. One is same-store sales, because that tells you how efficiently you're growing. The second is margins, because that drives it. If your focus is on margins, guess which multiple makes the most sense? What multiple has margins as its companion variable? Actually, revenue multiples, right? Earnings goes with growth. Margins go with revenue multiples. Revenue multiples you're going to see are much more intuitive. So when you talk to retailers about revenue multiples, they relate. Technology companies, especially money-making ones, is all about growth, and they talk about growth and earnings per share. PE ratios. Financial service companies, big focus on return on equity because the equity is marked up to market. It's got to be regulatory equity. It's constrained. Price to book ratios. You tell me what companies in a sector focus on, and the multiple kind of falls out of it. And you can extend this even to user-based companies. What do user-based companies focus on? Number of users. And not surprisingly, the multiple that seems to explain market cap best is number of users per company, price per user. So tell me what companies managers in a sector focus on, the multiple kind of falls out of that focus. Okay. So let me go through 4 steps. Start by defining the multiple, check for consistency, equity, enterprise value. Make sure it's uniformly estimated. Describe the multiple, not fancy. Put up a histogram, get a sense of what's high, what's low, the 10th percentile, the 90th percentile, the 25th percentile, the 75th percentile. Analyze the multiple. And in fact, when you describe the multiple, check to see how many companies you lose, because there is bias that gets created every time you lose. Analyze the multiple, use the little trick. If it's an equity multiple, go back to a dividend discount model, do the algebra. If it's an enterprise value multiple, go back to an enterprise value model, do the algebra. And only then should you apply it. Define, describe, analyze, apply. Okay. If you do this on 2 or 3 multiples, you'll very quickly catch on. The first time you do it, it'll be like a grind. But after you do it 2 or 3 times, you get a sense of what this is and why it's so critical that you do your homework first before you start applying pricing on your sector. So let's talk about asset-based valuation. Let me review intrinsic valuation. You value the company based on its fundamentals, its cash flows, growth, and risk. In relative valuation or pricing, you put a number on a company based on what other people are paying for similar companies. So sometimes, so when I tell people there are only 2 ways you could put a number, intrinsic valuation or pricing, they say, no, there's a 3rd way. How about asset-based valuation? I'm going to very quickly point out in a few pages why it's not a 3rd way. But for some, it seems like a 3rd way, right? You take the assets, you value the individual assets, you sum them up, you get a value for the company. You know what they're missing, right? To put a number on an asset, what do I need to do? I either need to do intrinsic valuation or I need to price the asset. So it's not a different approach. It's just an application of an approach. You're saying, why would I ever want to put numbers on individual assets? There are 3 scenarios where you would see yourself having to put numbers on assets. The first is if you're doing a liquidation of a company, because in the liquidation of a company, you're going to sell off the assets essentially for scrap. And you say, what is each part worth? The second is accounting valuation. Do you know that 65% of all valuations done in the world now are done purely for accounting reasons? What drove this was, of course, the push in accounting towards fair value accounting. So you walk in Ernst & Young or a Deloitte, and you go to the valuation section, you think they're valuing companies for transactions, maybe 2 out of 10 valuations for transactions. The bulk of the valuations are for restating numbers and balance sheets because the accounting rules require them to do. I'm going to come back and talk about that, but that the notion of fair value accounting that I think is an oxymoron and why I think it needs to be renamed. But that's a big chunk of what the valuation. So if any of you end up working in valuation, don't be surprised if many of your valuations are for these accounting purposes. And the third reason you might want to value individual assets is because you want to value the company as the sum of its parts, because you want to do something about it. You're a potential acquirer of the company, you want to acquire the company and break it up into parts. Or you're an investor interested in investing in the company because you think eventually any difference will have to go away. So let's take each of the, when you think about it, when asset-based valuation is likely to come into play. First, let's dispense with the notion that asset-based valuation is somehow a different way of doing valuation. Because ultimately, you've got to come up with numbers for the asset. And there are 3 ways you can do it. One is to do an intrinsic valuation of each asset, get cash flows in the asset, present value. The second is to price each asset, in which case you might get the earnings on each asset, apply a multiple to it. And there's a 3rd way, which is you trust your accountants and you use the book value of the asset as your estimate of the value. Incredibly lazy. But a lot of liquidation valuation is based on book value. Or, people prefer to use the word net asset value because it makes more sense, sounds like you've done more work than book, but it's book value dressed up. So let's look at when asset-based valuation is easiest to do and when it's most difficult to do. So you're looking at a company saying, should I be doing asset-based valuation? Asset-based valuation is easiest to do when you have separable assets. You know what I mean by that? The company owns 5 assets, each produces cash flows, but there are no interconnections. You ask me to do an asset-based valuation of Disney, I'm going to refuse on the spot. Why? Because if you want to value the theme parks, remember a big part of the value of the theme park comes from how well their movie business is doing. And now with streaming, how well their movie business is doing feeds into their streaming business. If you try to value Disney in parts, you're going to run into these issues of what do I do about these cross-business effects? Because they don't belong in any individual business, they come from. So the more separable your assets are, the easier it is to do asset-based valuation. You're a real estate company, you own 10 properties, each of which is a rental property. Asset-based valuation is trivial, right? You take each property, you value it by itself, you add them up. There's no synergies across. There might be some cost savings you get, but they're easy to deal with. the more separable your assets, the easier it is to do valuation. Second, it's nice if each individual part has its own financial statements. So you take a building and each building has a rental income, rental expenses, and each has a standalone financial, much easier because now you're not trying to guess where do the costs go. And finally, if you're doing pricing, it's nice if you have a market for those individual assets. Here again, you can see why real estate companies, it's all pricing all the time because you have individual assets, but they're part of this property. We can say, what does a property in downtown New York go for? You look at other properties that have sold recently. So when you think about when is it easiest to do asset-based valuation, you need separable assets with financials for each one. And it's nice if you can get other assets like it that are being traded out there. So let's take the three scenarios that we talked about and look at how we'd approach coming up with asset-based valuation. Let's try and liquidation valuation. So let's suppose I come to you with a company with multiple assets and say, what is the value of this company in liquidation? Remember, your end game here is you're going to sell off each asset, see what you can get. I think you should be more likely to do a pricing than an intrinsic valuation here, because in liquidation valuation, it's whatever people will pay you, right? Not what you think it's worth. You might even actually have to attach a discount for illiquidity because you're trying to sell something quickly, especially if it's a big asset, you might not get what you think is a fair pricing. But liquidation valuation, again, you're trying to get a sense of what would I get in the market today if I sold those assets. That's a pricing mission. So liquidation valuation, I don't think we should ever be doing discounted cash flow valuation. Unless you're curious, what's the point? But let's talk about accounting valuation. Called fair value accounting, right? When an accounting professor uses the word fair value accounting, I want you to put them on the spot and ask them, where's the value in fair value accounting? Okay. I mean, and to see that, let's actually step back. I remember when they were writing the fair value accounting rules, one of the things, the panel was dealing with was, hey, what valuation approach we use? So I remember reading the description, I think it's FAS 157 was the original, rule that described what fair value accounting's mission was going to be. And they talked a great deal about what a market participant would pay for an asset in an arm's length transaction. Let me repeat that again. They wanted to put numbers on assets that a market participant will pay in an arm's length transaction. That sounds to me like a pricing mission, right? What a market participant would pay. And then they dig deeper. In fact, you keep reading it. And the more you read it, the more you realize that what they want you to do is attach what you would get in the market today if you try to sell this asset. In fact, they make a big deal about exit value versus entry value, which I think is a contrast between a bid and an ask price, but it's basically a pricing issue. But here's the problem. If you look at how accountants are required to back up that pricing that they put on each asset, you know what they're required to do? They're required to do a discounted cash flow valuation. One of the most wasteful exercises I've seen in valuation practice. I just remember about 7, 8 years ago, I get a call, a fairly frantic call from the accountant. I forget which accounting firm it was that was called in by Fidelity to put a fair value on their Uber holding. Remember, this was before Uber went public. Fidelity had acquired this position in Uber. And because accounting requires that you mark to market, they had to call in the accountants to mark to market this holding. So the call starts off with, we have a problem. And I said, what's your problem? And so we're using a discounted cash flow model and we're getting only 200 million. And I said, why only? What does the only mean there? They said, we should be getting about 2 billion. And I said, if you already know what you should be getting, why are you wasting your time going through this discounted cash flow valuation? And you know how they came up with the 2 billion? This was right after the Saudi investment fund had invested in Uber at a $65 billion value pricing, not valuation. And they knew that Fidelity's share based on that pricing should be roughly 2 billion, but they were getting only 200 million. They said, what should we do? We've tried everything. And I said, you can take the DCF, and if you play enough with it, you can end up at 2 billion, right? Use a higher growth rate, increase the margin, lower the discount rate. We know all the tricks to play. You're going to have to hide it under different layers of verbosity, but basically, but you can already see it's pointless, right? It's a kabuki dance. You know you need to get to 2 billion. The DCF becomes a vehicle to get to 2 billion. You know what I would do if I were the accounting rule writers? I would say, don't use DCFs. This is a pricing mission. Tell me, wouldn't it be much more honest if you were told that Fidelity has just repriced its Uber holdings to 2 billion based on the Saudi investment fund's most recent pricing? Rather than tell you, we've done an intrinsic valuation of this Uber holding and it's worth 2 billion. Accounting fair value, I think, should be called accounting fair price. So first thing is I would remove the fair value, make it fair price, and allow people to back it up with just multiples and comparables. Do not use discounted cash flow models because this is not a valuation. The only problem is that means 90% of your work is gone. How do you charge all these? Don't they charge by the hour, or no? Is it? So you can run these DCF models as much as you want, but you're searching for something that you cannot find. Any questions on fair value accounting? So I think the problem is there's a mission split. What accounting rule writers claim they want you to do is at odds with the rules they've written about what they would like you to show. And that's creating an incredible amount of confusion in this process. So let's talk. Yes, go ahead.
So how would you account for like if you were to a company in the process of the liquidation, how should that impact the valuation of the company?
Valuation is not an issue. Liquidation, what are you going to do? You're going to get the best you can, right? So what does valuation even come into play? If this company or the valuable company is a going concern, wouldn't be liquidating in the first place. That game's been truncated. That's why when you do discounted cash flow valuation, we put in that failure rate. Because once you fail, nobody's paying you present value of future growth in the year 20 and terminal value as nirvana. They're going to pay you based on what you have in front of you. So once you enter liquidation, it becomes an entirely pricing-based thing. And that's why when you put in a failure rate, ask you, what percentage of your book value will you get back? Something to tell me what in liquidation value is going to be worth. And that liquidation value could be zero, some companies. Yeah. So let's talk about sum of the parts valuation. In theory, sum of the parts valuation, you take each part, you come up with a number for it, you add them all up, you come up with a value for the company. There are leakages in this process that we got to deal with, and we'll talk about what those leakages are. But it's often far easier to do an intrinsic sum of the parts pricing than a sum of the parts valuation. And again, if you think about who might be interested in a sum of the parts valuation, you might be one of those long-term patient investors who buys companies that trade at less than the sum of the parts, not because you plan to break it up, but you think eventually over time, this reality will catch up and market prices to rise to the sum of the parts. Or you can be somebody who wants to be an activist, who wants to take over the company, buy the company for whatever the prevailing price is, and sell off the parts that presumably you valued reasonably well, and come up with a number higher than you paid. So I'm going to take the United Technologies. I'll tell you why I picked United Technologies. First, this is not like Disney where you got spillover effects. So these are very different businesses. These are the businesses they're in. They're in refrigeration systems, defense, construction, security, manufacturing, and aircraft. 6 different businesses, siloed. And they were one of the few companies that actually gives you full information on each business. So this came right out of the financials. I didn't have to dig very deep. They give you revenues, EBITDA, operating income, CapEx, depreciation. In other words, it's almost like each of these businesses is treated like a standalone business. It's very unusual to have this much detail by business. So here's my first track. I'm going to do a sum of the parts pricing, but I'm going to do the back of the envelope version. Here's what I'm going to take the EBITDA that they gave me for each of the companies. So there are my EBITDAs. I'm going to take an EV to EBITDA for the sector that each of these companies operates in. So I found publicly traded companies in each one. And I'm going to multiply the EBITDA by the EV to EBITDA to come up with the enterprise values, and I add them up. The value that I got for the operating businesses was 61.7 billion. This is what most analysts mean when they say they've done a sum of the parts valuation, is they've taken the EBITDA or revenues or earnings or some common metric, applied a multiple, an average for the sector, and added them up. Play devil's advocate. What am I going to miss when I do this? What am I assuming about each of United Technologies businesses then when I use the average for the sector? Yes, I'm sorry. Similar cash flow, similar growth. So first thing is, and so one of them is a higher growth than the rest. I'm missing that. The standard problem of applying an average. What else am I missing? I'm taking the EBITDA of each of the six.
Or that they are not interrelated.
Which is good. If they were integrated, then I'd be. So I don't want integration, right? So when you say they're not integrated, what exactly are we talking?
Integrated value might be participated.
Tell me why though. It's got to show up somewhere. So what number would it show up in?
They're able to cross-sell or retain the clients.
But where would that EBITDA show up? Because remember, the sum of this EBITDA is the EBITDA for the company, right? So if it's showing up somewhere, so if that's happening, it's not that it's disappearing, it's actually slipping into, so if there's cross business, then what's happening is the EBITDA for one business is being moved to the EBITDA of another. I'm applying the wrong multiple because my refrigeration systems is selling to my fire and security. So it's not disappearing, it's just in there, but in the wrong place. That's a problem when I do a company like Disney, right? The theme park EBITDA might be 20% because my movie business was doing so well. Not so much of an issue here. What shows up below EBITDA? You might have other expenses, which might be corporate expenses. Okay. If it doesn't show up in SG&A and shows up below, it's possible there might be some corporate expenses that are there that I'm completely acting like, you know what, I'm taking a very cynical view, which is if tomorrow these companies broke up, that corporate G&A can go away and nothing gets affected. And cynically, you can say, well, that's always the case, but you can argue that sometimes when you centralize things, that removing it will cause costs to revert back to these companies. I think if you just do a pricing based on stated EBITDA of the businesses, you often overstate the pricing of the company because those common costs then somehow get ignored or missed. We'll talk about what to do when we do an intrinsic valuation. Is there a way I can fix the problem though of these businesses not being like the average business? What do we do with traditional pricing to bring in the differences across companies? We did a regression, right? It's a lot of work, you're saying. You're right. You have to run 6 regressions. I actually ran more than 6 regressions. I tried 3 different multiples. I stayed with enterprise value because I don't want to go to equity value at a business level because who knows what the debt is. I stayed with enterprise. I did enterprise value to sales, enterprise value to EBITDA, enterprise value to invested capital. I ran all 3 regressions for each of the 6 businesses. And here I was agnostic about which one to pick. I didn't have a strong preference. I picked the one which had the highest R squared in each one. You know what I'm going to do now, right? I'm going to plug in the numbers for United Technologies, refrigeration systems, tax rate, and return capital. And I'm going to come up with a predicted multiple enterprise value for each of these businesses based upon these regressions. At least I've taken care of one of the problems. I'm no longer assuming these businesses are just like the average. I'm allowing for differences. The value that I got was 74.23 billion. So there's my regression number predict. So the only difference between what I'm doing here and what I did before is there every business I used EV to EBITDA. Here I can use different multiples for different businesses, depending on which business I'm in. And so I've added about $8 billion to my overall value. What does that mean? The typical United Technologies business actually is a little better than the average company in that sector for whatever reason. And this higher value, higher pricing reflects that they're superior in growth of lower risk or something else that's making them priced higher. But I'm still pricing, is with regard. So I've got a 66 billion back of the envelope, 74 billion with these kind of finesse regressions. But I really wanted to do a true intrinsic valuation. Who do I need for a true intrinsic valuation? Everything I need for any intrinsic valuation, right? I need cash flows and growth and risk. So here's what I started with. I started by estimating a cost to capital for each of the 6 businesses. Remember how it got bottom-up betas? No, we took, instead of taking a weighted average, I'm actually letting each one play out as a different cost of capital for each business. So you'll notice that my debt to equity ratio is the same, because United Technologies did borrow as a company, and I didn't feel any of these businesses were off the map in terms of how much debt they should have. They're all required manufacturing, so I put them all in with the same debt to equity. But if you wanted to, you could actually change debt to equity ratios, have each business carry a different debt to equity, as long as the sum of the debt across the businesses adds up to the sum of the debt of the company. So I've computed debt to equity ratio and a levered beta, different costs of equity. Their fire and security business is the safest, and their riskiest business is their helicopter business, Sikorsky. Okay. But I gave them all the same cost of debt for the same reasons. I gave them the same debt ratio. The company is borrowing for all 6 businesses. I used the rating for the company and the cost of debt. But the bottom line is I have 6 different costs of capital. Why? Because I'm going to value each one separately. I have a cost of capital for each one. You can already see that if you're doing this for Coca-Cola, geographically, the beta is going to be the same, the unlevered beta and the levered beta. But what's going to be different is the equity risk premium used for Asia will reflect the weighted average ERP for Asia. So you're going to end up with very different costs of capital. Now, to get the numbers for the growth rate, I'm going to go to the shortcut. Remember, when margins are stable, I can use the return on capital times the reinvestment rate. I compute the returns on capital for the 6 businesses. Notice the outlier, the fire and security business, which is the least risky business, also has the lowest return on capital, and at the reinvestment. So I have the return on capital and the reinvestment rate for each business, I have the cost of capital for each business. I have the fundamentals I need to drive the value of the company in there. I plug them in. And in fact, because I'm valuing each business separately, I can make my own judgments. Some are high growth, some are already mature. I didn't have to put one size fits all. And you can see that I've actually assumed the fire and security business is a mature business with 0 years of high growth. The other were all moderately high growth. None are high enough. But if United Technology had a gaming business or an AI business, I can add that on, right? Very different cost of capital. I might have a 10-year growth period. I can have negative margin. In essence, I'm doing what you did for one company, I can do for each of the businesses separately. Different revenue growth, different margins, different reinvestment, and different cost of capital. Here's the bottom line, though. When I do my intrinsic valuation for these businesses, the value that I come up with, if I do the intrinsic valuation of each of the businesses, is $80.25 billion. That's valuing each business separately. That's higher than either of the pricings, but that's neither here nor there. This is an intrinsic valuation of each of the 6 businesses. And here I want to tie up that loose end. And the loose end was that United Technologies had $408 million in corporate expenses that were unallocated. You know what that means, right? All my free cash flows are before these expenses. So these $408 million in expenses are still there. I decided to take the non-cynical view that these $408 million were providing services that cut across the 6 businesses. They were not going to go away next year. So I took the present value of those savings over time. So it's just the present value of a growing perpetuity. I'm assuming these costs will continue to, for the company over in perpetuity. The present value of those corporate expenses is $4.587 billion. So I take the $80.3 billion that I got for the 6 businesses. I subtract out. You see why I subtract out? These expenses are going to drain value. They're just collective expenses. The value that I get as the sum of the parts DCF is $75.7 billion. I actually, when I did the pricing, got 74.2. I actually did a full-fledged DCF of the company overall. It's a consolidated valuation. I got 71.5 billion. And part of the reason was then I had to make one assumption about growth periods, and it forces all of these businesses into one grouping. So the range of value is actually outside of the actual market price was 52.2 billion. So if you looked at the actual traded value, it was lower than any of these numbers, but it was significantly more undervalued using an intrinsic valuation sum of the parts than when you did pricing. Yes. I prefer the word equation rather than formula because formula, yeah. Remember the regressions, all you need is uniform. So if you decide to go effective for all of the companies. If you decide to go marginal with all of the companies and yours, right? The problem with marginal is if you pick companies within the same market. Marginal tax rate is the marginal tax rate, right? It's going to be the same. So if you believe there are tax differences across companies, an effective tax rate is probably going to capture that better than marginal tax rates. So given a choice, I'd probably go with effective tax rates. But if you decide to go marginal, you have companies in multiple countries, and you worry about marginal tax rates driving how they're being priced, then you can use the marginal tax rates, but then use that for your company as well. The simple rule is whatever you use in your regression, use for your company as well. Use the same definition. So use return on invested capital, you do the return on invested capital for your company as well. Yes.
So if I wanted to calculate, suppose that this company is divesting one of the businesses, would it be fair to allocate some of the corporate expenses?
You should, right? Because otherwise, in fact, that's a very good point. Often in divestitures, you'd see people taking the financials that they gave you for that subsidiary and valuing it. So that's how much I'd pay. But then after you buy the company, you know what you're going to discover? They don't have an accounting department. So how did you get away with that? Well, corporate took care of that. You don't have an inventory or why corporate? So what you're going to wake up to are unpleasant surprises afterwards. So I think you have to do that, right? You have to take the corporate expenses and decide what portion of that was due to this division. If they won't give you the information, base it on revenues, allocate it like accountants would and say that portion is going to go there. Otherwise, I'm going to overvalue the company. That's the other thing I could have done is I could have taken the 408 million. I knew the revenues and EBITDA for each business that allocated across the 6 businesses and reduced the EBITDA for each business. That way, it's not a separate item. Now, here I just took it as a consolidated and used the company's cost of capital to discount. Yes.
Yeah, so the corporate expenses just come from like the consolidated income statement.
It comes from the fact that the headquarters, usually these companies, United Technologies, the headquarters, some functions are centralized. I use the example of accounting. Accounting tends to be centralized because they prefer to run it out of headquarters. So that becomes essentially that becomes a cost. That headquarters building, everybody who stays there. Now, GE's headquarters were what? Connecticut, huge space, but nothing that GE actually did came out of that space. But think of all those expenses of maintaining the space, all the people who work there. Presumably all of GE's businesses gained from the people working there. But that's what that G&A is that centralized cost where every business benefits from it. But they centralized it because they thought they got economies of scale. They did it for the best of intention. They weren't doing it to make evaluation more difficult. I'm just bringing it in separately. So I want you to think about if you were trying to do this for a Coca-Cola, what the challenges would be. And the next time somebody casually says, Sony is trading at less than the sum of its parts, push them on it, right? Think of how, this is the easiest of the sum of the parts valuation. It's 6 very different businesses. Think of Sony's business and ask yourself, how am I going to draw the lines on separable businesses? How am I going to get the information? And how is it that you can so casually decide that something is trading at less than the sum of its parts? I think for every 10 times I hear about companies trading at less than the sum of the parts, maybe 1 out of the 10 is true. The other 9, I'm skeptical. You just think the company's undervalued. You use the sum of the parts as a neat little excuse for doing it. But it's not as if you've done a serious sum of the parts valuation to make that judgment. Why might a business trade at less than the sum of its parts? Philip, yeah, go ahead.
Bad management.
One is, but shouldn't that be in the numbers already?
Because if their assets are worth more than value that, then you argue that.
But I'm asking about some of the parts valuation. So pricing can be all over the yeah. Philip Morris used to own Kraft Foods. They spun off Kraft Foods because they felt that there was a contamination effect. You know the contamination effect they're worried about, right? So tobacco companies were being sued. they said, my intrinsic value of Kraft Foods is actually being reduced because I worry about the spillover effect of cigarette lawsuits affecting what I do at Kraft. So one is if you have a company that has acquired a poisonous reputation and you worry about that affecting the numbers, you might argue that removing that company from the businesses could potentially give you much higher values for the businesses, right? So it could be that, it could be taxes. Maybe you're being taxed more, it can cut both ways, but maybe you're paying a higher effective tax rate as this consolidated company, but if you broke it off into individual parts, this used to be true for US companies with subsidiaries outside the US when the old US tax law required that all the income be taxed the US tax rate. There was actually an incentive for these businesses to spin off their foreign subsidiaries and let them stand alone because overnight the taxes drop. Yes, sir.
How often, like some a company's subsidiary in some reason is facing litigation charges? For instance, like Bayer is facing
Well,
litigation related to
yeah.
ground.
Well, in a sense, then breaking it up into parts essentially gives you a legal benefit, right? Because then you're arguing that they can't come out, especially if that subsidiary is a small, not that valuable subsidiary, and you have a really valuable parent company. The only thing is the lawyers are not going to sit there and let you do this, right? So they're going to go to court and say this is a tactic to. So it's not as easy as it sounds. Bayer actually had to pay a substantial settlement to get away from the Monsanto lawsuits. But no, I'm sure legal issues can push you towards breaking up if it means protection. I think Johnson & Johnson was also created a subsidiary for their for portions of their legally targeted businesses. Yes.
What about a company like Amazon? People demand percentage spin off to AWS.
I don't for a second think Amazon is what. Do you think, if AWS is really not would you want to take Amazon Prime? I don't see how AWS is hurt by the rest of Amazon's businesses, right? So unless you could show me some kind of antitrust thing that's now going to be imposed on AWS because people don't like Amazon, I'm not sure there's that much of a gain.
What about one? That's generating cash. We'll reinvest in that into.
Well, it allows them to set for lower margins and it's a cash cow, right? And to the extent that it's a cash cow, it allows them to take risks in their other businesses that otherwise couldn't have taken, right? So you could argue that the growth of Amazon Prime was made possible by the last 7 or 8 years of cloud cash flows. So I could give you just as good a story about how this is increasing the value of Amazon collectively by having a cash cow in the middle. No. So, but I think that if you spun AWS, it's not just another cloud company. It's not going to be the greatest company on the face of the earth, and Amazon is going to keep going. I mean, and I know that Scott is big on breaking up the big tech companies. He wants to break up Facebook into Facebook. I mean, those companies will be worth less as their part if they break them into parts, right? Because it's the ecosystem that makes the networking benefit so high. So you take Instagram, you separate it from Facebook, and you take Facebook and separate it from WhatsApp. As standalone businesses, they're definitely going to be worth less. So there, the objective is not to increase value, it's to make them less powerful. Maybe that's Scott's point, but it will make them less valuable as a collective business. Yes.
So in the example of that period of the Morris and Kraft Foods, if there is not a lawsuit or legal avenue, can you actually estimate what the contamination effect on food would be?
You'd have to give, so it will show up in Kraft Foods margins and what they can do. Maybe their growth is being constrained because they're part of Philip Morris. When they try to grow in a country, the country says, look, you're a tobacco subsidiary, we're not going to allow you to grow. So maybe value them twice, once without the constraints imposed by being part of Philip Morris and one with the constraints, and they're different. Every green energy business that's part of a fossil fuel company faces this problem, right? They compete against a standalone green energy company. They might be at a disadvantage in winning that bidding war because people say you're an Exxon Mobil subsidiary and you're competing against this green energy company standing alone. That's why I think traditional companies in the fossil fuel space have so much difficulty getting their green energy business off the ground. Is that contamination effect can affect them in how quickly they grow and how they attract employees and everything else that goes with it. Yes.
So, like, is it the case that the overall value of the less than single parts, like on the investor base, so different because.
You could, right? Because once you, that's actually a good point. Alibaba is breaking up into its constituent parts. What do you think the reason there is? Why 2019, of course, Alibaba was, I mean, the Chinese government was viewed as an ally for Alibaba until 2019, right? That things seemed to change, and all of a sudden the Chinese government decided they're going to take a harder line with their biggest tech companies, Alibaba, Tencent, JD. And ever since, Alibaba's been under a dark cloud. It's almost like Alibaba's throwing the, it's saying, look, we'll break up into 6 smaller companies. Maybe we'll be less scary as 6 separate companies, and you can now attract different investors. Maybe Alipay will attract a different investor base that might not have been. So that's a pricing argument. It's a demand supply argument. It'll push up the pricing. But I think that from a pricing perspective, sometimes breaking a consolidated company into its individual groups might allow you to attract different kinds of investors for different groups and essentially push up the pricing. So, but we have to separate the valuation arguments or the pricing arguments and see which one's driving this particular part of the process.
The valuation of the cost of capital base.
Yeah, but that's got to be a really strong, remember, any cost to capital argument I'm going to push back on, right? Because costs of capital are very difficult to move by just breaking up and getting listed in a different market. But there you could make it an intrinsic value argument if you can convince me that by breaking up into individual pieces, you're able to have, usually it cuts the other way, right? I gave all of United Technologies businesses the same cost of debt. My guess is there are individual businesses, some of them face higher costs of debt, but if you can show me that the cost of capital will be lower, you can make an intrinsic value argument. No, I hate I'm sorry about the colors. I wish I'd used something a little more. This is actually GE about 4 years ago. It was already a walking dead company. And I want to use it to illustrate one very simple point. One is, I'm glad I did not do this GE in 2006. There've been 26 rows in this, 26 different businesses. This GE after that slimmed down, if you can call it that. Look at the business it's in. You're saying, why are they shaded? One of the nice things about breaking a company down by business is, remember our test of return on capital being higher than the cost of capital. We did that at a company-wide level, but now I can do it by business. So when I looked at GE, and as I said, if this was 5 years ago, the 3 businesses where they earned above their cost of capital were aviation, healthcare, and transportation. Think of this as 3 potentially good businesses. The 3 that where they roughly earn their cost of capital are yellow, and then there are 2 awful businesses. GE Lighting, I use GE, but I don't know what happened to that business, but it looks terrible from a return on capital basis. And GE Capital is just a disaster waiting to happen. In fact, when I value the 6 businesses, I value GE Capital at 27.08 billion. But remember, that's the value of the business. The debt that GE Capital carried was 51 billion. 27 billion minus 51 billion. It's mine. One business has a value of minus $24 billion. See, why don't they just shut it down? Obviously, people are not going to pay for it. The problem with GE Capital is it's entangled everywhere. GE Capital actually backs up many of the GE aviation sales that they do to their customers is backed up by GE Capital. GE's problem has always been because GE Capital is so entangled, and this was Jack Welch's worst legacy, is by bringing in GE Capital and entangling in all the other businesses. It's almost impossible to do a true sum of the parts where you separate the parts, because 5 years ago, I think everybody accepted that GE should probably be broken up. The only question is, how do you break up a company where you have GE Capital kind of holding these businesses together? And what do you do about GE Capital? Yeah.
This conversation will come down to one's personal view on how well internal capital markets function. And your view on Amazon is this in that you think Bezos and his friends.
That's a good point, because anytime, I mean, I'll take an example from India, which has troubled a lot of people. Reliance is one of India's largest market cap companies. And over the last decade, Reliance has invested billions of dollars in Reliance Jio. Jio is a telecom business. And Jio's business model, if you look at it, is basically give away telecom services for nothing. I think every online company that has gone public in the last 5-10 years in India should give a third of their value to Reliance Jio, because Reliance Jio has essentially made broadband accessible to hundreds of millions of Indians. But it's a cash drain. And you have zero power over how money gets moved around Reliance. And people seem to be okay with it because of this trust of, hey, Mukesh Ambani is not a dumb guy. I'm sure he's thinking about the right things when he does this. But I think the minute that trust fails, you're going to get a very different perspective. You're right. For the moment, I think Amazon, but remember, Jeff Bezos is no longer there. It's now Andy Jassy's company. I don't think he has as much of a leash as Bezos did. So already you can see people saying things about Amazon that they weren't talking about 2 or 3 years ago. They're talking about how Amazon has let its online retail business kind of get, they've been distracted. So I've seen things said about Amazon that suggest to me that the trust is fraying. And once it frays enough, you could potentially see people arguing, we don't want, AWS to be part of Amazon because we no longer trust Amazon's management to do the right thing. It's a point that Facebook has reached, right? 3 years ago, 5 years ago, Facebook had done what they did, they probably could have gotten away with it. Now people have lost trust in Zuckerberg. So when he says, trust me, I know what I'm doing in the metaverse and I'm going to spend 100 billion. So why should we? So I think it is true. Trust is a big factor when you have these internal capital markets. And when Jack Welch ran GE, there was supreme trust. Greatest CEO on the face of the earth. He can do whatever he wants. And I mean,
This example is showing that
that's exactly right. Well, yeah, and this is the reason I think when corporate governance matters, even when you think management is good, you need people pushing back, saying, "What's the downside here?" And nobody pushed back because he was a complete ruler by the time he got to the end of his tenure, or even by the middle of his tenure. Let's at least get the process started on valuing private businesses. First, let's be very clear. Valuing a private business, a value of a business is driven by cash flows, growth, and risk. If that sounds familiar, that's because private business and public business, it's the same rule. That said, though, there are 2 things you're going to run into with private businesses that will potentially make your life a little more difficult. The first is, there is no market value. You're saying, so what? It's only when you value private businesses that you realize how much you rely on market value when you value public companies. So I'm going to talk about where you will miss it and what you might need to do to make up for it. The second is, if you are worried about accounting differences across public companies, you should see the accounting differences across private businesses, especially small private businesses. So let's take those 2 factors and look at why they become an issue in valuation. First, you know what I mean by no market value, right? The publicly traded company, there's a market price out there. And there are 3 levels at which you miss market prices. First is, there are market values that you use as inputs into your DCF valuation. Like where? When you do your cost of capital, your weights on debt and equity are market values. You don't have them. When you think about, valuing options that your company's done, what do you use? Use the market price per share. So that's the first place you're going to miss them, is in those input numbers. The second is a little more subtle. I want you to think about the moment you finish the valuation of your company. Think of the first number you checked after you finished your valuation. You checked the market price, right? The market value is very different from the market price. What did you do? You went back and you looked at the numbers again, and I'm leaving it at that. Maybe you did more than look at the numbers. There's a feedback effect, right? Because if you get a $3 value per share and the market price is 300, this isn't a supremely overvalued company. You probably got the units wrong, or it's amazing how much feedback you get from the market price that goes back into your valuation. You don't have that with a private company. You could get $3 when the real value is 3,000. Your units are off. You have no way of even knowing until it's too late. And finally, if you would think about the traditional ways you estimate risk, how do we get a beta? We run a regression of what stock prices against the index. You don't have that with private companies. So that's the first thing to get used to, is there is no market price crutch to fall back on. And in terms of estimating cash flows, it's true, you start with the financials, you go through the same process, but many private businesses, you have a much shorter history to work with. Okay. Second, as I said, accounting standards can be all over the place. If you have private companies of reasonable size, if you go walk into, Coke Industries, you're going to get something that looks very much like public companies, but you walk into a small retail business that's owned by the person behind the counter, the accounting can be all over the place. I still remember somebody in this class about 10 years ago decided to value their flowers, their mother's flower shop, because she wanted a valuation. And she said, I'd like to value my mother's flower shop. I said, be my guest. But 4 weeks later, she showed up in my office. I need to change companies. I said, what happened? Do you have a fight with your mom or something? She said, I went and asked my mom for the financials, and she led me into a small back room, and the walls were all covered with Post-it notes. Yeah. And she said, this is my revenue wall, and she had different colored Post-it notes, the red Post-it notes. This is my expense wall. Every time I have an expense, I write in a Post-it note. I don't think Post-it note accounting is under IFRS or GAAP, but you can see why she had to do that, right? She had a store to run. Who has the time to sit around doing accounting statements? At the end of the year, presumably she pulled off all these Post-it notes and took it to an accountant to pull the numbers together. But especially with small private business, the accounting can be all over the place. The third is with private, this is true in every business, with private businesses, there's line between the personal and the business becomes a hazy one, right? There's a company car, but at 3:30 in the afternoon, it seems to disappear for about 45 minutes when the kids get out of school. It picks, I mean, you run a private personal business, even though you might never tell the IRS this, there are these lines that get crossed. I call this, and there are people who want, who sometimes are shown as employees for a private business. So what do they do? And I don't know. They have the same last name as the owner. I call this the George Costanza effect. In all my years of watching Seinfeld, I could never quite figure out what George did for the Yankees. I think there was one episode where he changed their uniforms to polyester. It did not end well. But most of the rest of it, what exactly is the assistant to the equipment manager, whatever his title was, what do they do? There are a lot of assistants to the equipment manager at private businesses. No, let me show. And finally, and this is a big deal and something to think about, is many private businesses, the owner doesn't pay himself or herself a salary. What's the point anyway? You get whatever's left over. You're saying, who cares? When they do their financials, they do it without showing that salary. You see what this is going to do, right? The income you're going to see for private businesses. So if you buy this business based on that income, guess what you're going to wake up to the next day? You walk in and say, who's doing the accounting? Huh? Person walked away. Well, who does the floors? The owner does the floors before she leaves in the evening. You now have to replace all of those people, and it's going to cost you money. We're going to talk about how this has to be factored in to valuation. So let's start with a statement about private company valuation. Motive matters. What does that mean? Now, I'm going to show you a couple of valuations, but I remember about 25 years ago, the owner of a candy company walks in into my office and she says, I'd like a valuation for my candy company, as if I'm sitting there, but she was all very persistent. And I said, why? She said, what do you mean, why? I said, why do you want to value you? And I gave her the reasons. Are you curious? That could be just, because you own a business, you want to see what it's worth. Is it because you're getting divorced and your spouse is going to get half of this business, in which case the valuation you want is probably zero. Right? Is it because you have a transaction? She thought about it for a moment, said, I want to sell the business. I said, to whom? She said, you have a lot of questions. I said, I need to know. She said, what do you mean to whom? Are you selling it to a publicly traded candy company? Are you selling it to a private equity investor? Are you selling it to an individual? And she thought about it for a moment. She said, it's an individual. I said, can you tell me more about the individual? Is it a wealthy individual who's buying this as a hobby, or is it? And you're going to see why all these, because in the public company, you never ask these questions, right? You value a company, you just come up with the value. Valuations of private companies are much more specific to the company you're valuing at the time you're valuing and the mode that's being used, which means that private company appraisers, you're going to have a much more difficult time replacing them with AI if they do their job right than public company valuations. Motive matters because if your valuation is a show valuation, which is curiosity as opposed to transaction valuation, I can come up with very different numbers. So what I'd like to do is actually talk about 4 scenarios in private company valuation. I'll start with the most difficult one, a private to private transaction, an individual selling to another individual. Used to be very common, lots of different professions, right? You were a doctor in the US until about 20 years ago. You built up a practice, you got to the age of 65 or 70. You know what you did? You sold your practice to another doctor. You're saying what's happened in the last 25 years? It's become corporatized. Your business, but those days, you just, dentist, you sold your practice. A plumber who built a business, you sold the business, a private to private transaction. Most difficult scenario in private company valuation. The second is a private to public. And I'm going to argue things got a lot easier. What's a private to public? You have a private business, but you're selling it to a public company. This candy business being sold to a publicly traded candy company, to Hershey's. Very different set of circumstances. You made my job a lot easier, and you're going to see why. You can have a private to IPO. You're a private business. You're actually getting a valuation because you want to go public. We'll talk about the issues that come up when you value a company for a public offering. And finally, you have the 3-step process. You're a private business. You're valuing a business because a venture capitalist is interested in investing in your company. And then that venture capitalist plans to take you public. We'll see how the process plays out over time. So let's start with the private to private transactions and talk a little bit about the challenges in valuing private to private businesses. First, when you have an individual selling a business to another individual, let's start by being very open about the fact that it's very unlikely that either of those individuals is diversified. You see why this matters, right? All of our calculations so far, when we did cost of equity, cost of capital, were built on the premise the marginal investor is diversified. Therefore, the only risk they care about is the risk you cannot diversify away. This kind of removes the entire foundations for using beta, right? Because beta is built on the premise that the marginal investor is diversified. That's unlikely to be. Second, if you're buying a private business, a farm, a plumbing business, you change your mind. And I'm going to call it, so people talk about liquidity discounts. I think of it as the cost of buyer's remorse. Have you ever had buyer's remorse? You're listening to Jim Cramer in a moment of weakness. You actually do what he suggests, right? He says, buy Silicon Valley Bank. You hit the buy and he said, second later, he said, what the heck did I do? This guy screams out like 50 companies every 20 minutes. And there, what's the cost of buyer's remorse? You reverse the transaction. You paid what? If I'm on Schwab, it's $5.95 each way. That's about $12. And there's a bid-ask spread that I pay. But that's a cost of buyer's remorse in a public company. It can be tiny if I'm looking at a company like Apple. It can be much bigger if I'm looking at a lightly traded stock because the spread is wider. But think of buying a farm or a plumbing business in a moment of weakness. You're tired, it's the end of the day, you're on your way home, you take your entire savings. You buy a plumbing business, you get home and you tell your spouse what you did. She says, what the heck did you do? Go sell it. Think of how much more difficult it is to reverse, right? So you know what you have to do when you value private business? You have to build in that expected cost of buyer's remorse at the start of the process. It's called applying an illiquidity discount, something you don't ever think about with public companies. But you have to with private businesses. And finally, with private businesses, there is this issue of a key person value. Maybe you want that plumbing business, great income statement, right? You buy it based on the income statement. In fact, I'll make this even more specific. My kids all had to go to get braces. This is an incredibly lucrative business. Now, my dentist, his first name is Howie. He got rich just based on my kids, I think. And every time he'd come in, I'd wait for my kids' braces to be tightened. This is like a weekly or a monthly thing you've got to go in. And every time he'd take the opportunity to ask me questions about investing and valuation. So go in one time and he says, while the braces are being tightened, can I ask you a question? I said, sure. He said, I'm thinking of retiring. I said, no, 40 years old. He said, your kids have made me rich already. I'm okay. I'm thinking of retirement. I'm thinking of selling my business. He says, I've made a lot of money last year. I know, my credit card shows that already. He said, but I have a problem. The people who are, that I'm talking to about buying the business don't seem willing to pay based on that income. And you can see why, right? You buy this guy's business, Howie's business. You install yourself as the dentist. I come in with my kids and I say, who the hell are you? So I'm your new dentist. I said, no, you're not. And I walk out. That's a key person discount. Essentially, the expectation that the person running the business walks out, there goes 20, 30, 40, 50% of the revenues. So we're going to talk about what that discount is and how you as the owner of a business can reduce the discount. In fact, while we're on it, how do you reduce that discount? What do you think I told Howie to? He said they're knocking off 30% or 40%. I'm sorry?
No, let's stay on.
Basically, that's what I said. Look, sell the business, but stay on for 2 years. Put up a nice, comfortable, easy chair. Sit there when somebody comes into the patient. Walk the patient over to the new dentist. Say, this is the new dentist. And often you see these overlaps between an old player, doctor, dentist, and they're not doing it because they want to stay around. It's because that eases the key person discount and allows that discount to become small. It might still be there, but it's a much smaller discount. So next session, what I'm going to do is I'm going to take an example of a private to private transaction and look at how these play out. And I'll be quite honest, this is part of valuation where there's the most fudge that we're going to do because there's no precise answer, but at least we can think of a way of reasoning our way to the diversification effect, the liquidity discount of the key person. Okay.
For the 3D example, how do you